In the span of 48 hours, silver did something markets are not supposed to do when the plumbing is healthy. A single risk control decision made it thousands of dollars more expensive to hold the same leveraged exposure, and the price action immediately shifted from orderly trading into something closer to a scramble for exits. $44 an ounce, then margin requirements, on the March 2026 contract were raised by about $3,000 per contract, moving from roughly $22,000 to roughly $25,000. That is the kind of change that turns a normal pullback into a forced liquidation event, because it hits every leveraged participant at the same time. They said this kind of stress could not appear in a market as institutional as silver. They said there was enough metal. They said inventories were visible, exchanges were resilient, and the system had buffers. But when the cost of carrying exposure jumps overnight, the market reveals a truth that is easy to ignore in quiet times. The constraint is rarely whether silver exists somewhere on Earth. The constraint is whether it can be delivered, financed, and mobilized right now in the exact form and location that settlement and industry require. And here is the uncomfortable asymmetry. Institutions do not need a dramatic headline to sense when claims are growing faster than immediate deliverability. They feel it in funding markets. They see it in the terms for borrowing metal. They watch the relationship between futures prices, lease rates, and delivery behavior. By the time most people hear the word shortage, the decisive positioning has often already happened. What follows is not hype and not rumor. It is a walk through confirmed signals, historical patterns, and the market dislocations that appear when the paper layer and the physical layer stop moving in sync. Welcome to Signal and Silver, where we decode what matters before it becomes a talking point. This channel is about mechanics, not memes. It is about the quiet data that moves first: margins, lease markets, vault classifications, delivery, incentives, and the difference between owning price exposure and accessing metal. If you are listening, drop a comment with where you are watching from, because this market is global, even when the headlines are local. And if you like analysis that connects dots calmly, consider subscribing the way you keep a wise voice in your circle. Not because you need noise, but because you want clarity. Now, let's get forensic about what actually happened. On December 29th, 2025, CME raised margin requirements on the March 2026 silver futures contract. The numbers are straightforward. Roughly $22,000 became roughly $25,000, an increase of about $3,000 per contract. Margin is not a fee you pay once. It is capital you must post and maintain to keep the position open. If the market moves against you, you may need to post more. When the exchange raises the baseline requirement, it instantly increases the cash demanded to keep the same exposure, regardless of whether you were right or wrong about the long term. In a normal market, margin policy is background noise. In a stressed market, margin policy becomes the lever that reveals where fragility has accumulated. The abnormality was not that an exchange managed risk. The abnormality was the combination of elevated prices, heightened volatility, and a margin shock arriving when many positions were built around the assumption that financing conditions would remain stable. When you see a sharp sell-off in the wake of a margin increase, it is not simply sentiment flipping. It is structure shifting. Some holders cannot or will not add cash, so they reduce exposure, and that reduction becomes price pressure. This is where the central mystery comes into view. If silver is abundant, why does the market behave as if it can be destabilized by financing terms? Why do headline inventory totals look large, while the cost to borrow physical metal spikes? Why do some institutional voices argue there is no global shortage, only a location problem, while other signals price immediacy like the metal is suddenly hard to source? Those contradictions are not noise. They are the story, because they tell you which part of the system is tight. To understand that, you need the hidden pattern. Silver's most memorable episodes are not gentle trends. They are violent surges, abrupt tightening of trading conditions, and sudden reversals that teach the same lesson. Leverage can outpace liquidity, and when risk controls tighten, the unwind can be faster than any fundamental analysis expects. In 1980, silver's speculative frenzy became a permanent reference point, and when conditions tightened, the reversal was brutal. In 2011, silver climbed rapidly again, reaching levels in the high 40s per ounce, and the period is remembered not just for the rise, but for how quickly conditions changed when the market's leverage became the risk. Those parallels matter because they show how silver behaves when it becomes a leverage magnet. Silver is smaller than many financial assets, so concentrated flows can move it. It also sits at the intersection of investment demand and industrial demand, which creates periods where narratives collide. A currency hedge story can overlap with an electronics supply story. A recession story can overlap with a solar manufacturing story. That complexity makes silver vulnerable to oversimplification, and oversimplification is where people get trapped. Silver is not only a story about price, it is a story about access. Now bring that pattern into the current cycle with confirmed anchors. Through 2025, silver lease rates spiked repeatedly, including a fifth spike that year according to reporting on the lease market. Lease rates are the cost of borrowing physical metal. They are a financing price for immediacy. When lease rates rise, it often means someone is willing to pay more to access metal now rather than later, or lenders are demanding more compensation to part with metal at all. Lease spikes do not automatically prove the world is out of silver. They do prove the market is putting a higher price on immediate access. At the same time, London Vault data provides another anchor that prevents this from drifting into speculation. $4 billion, representing about 927,254 standard silver bars. That is a vast amount of metal by everyday standards. It is enough to make any casual observer dismiss the idea of shortage instantly. But markets do not trade everyday standards. Markets trade availability at the margin, and availability at the margin is where price is made. Here's the hidden pattern that reconciles the contradiction. Inventory can be present and still not function as supply. Some bars are owned by holders who will not sell at current prices. Some are pledged as collateral in financing structures and cannot be freely mobilized without unwinding other positions. Some are tied to long-term industrial programs where disruption is more expensive than paying up for metal, so the holder refuses to lend it. Some are in vaults or jurisdictions where moving them is slow, costly, or operationally constrained. Some are in forms that do not match a specific delivery standard without conversion, time, and cost. And some are visible in total inventory, but invisible as practical supply, because the owners treat them as strategic reserves. Now, let's talk about the institutional movement, because this market is not a single arena. First is the exchange and clearinghouse, which must manage systemic risk. When CME raises margin, it is signaling that volatility has increased and that the clearing system wants more protection. Second are the leveraged participants, commodity funds, systematic traders, and speculators who trade contracts because contracts are liquid and scalable. Third are commercial participants, miners who hedge future production, refiners who manage input costs, fabricators who lock in supply, and industrial buyers whose priority is continuity. Then there are the bullion banks and large dealers that sit between paper and physical. They manage unallocated accounts, facilitate leasing, arrange swaps, and provide liquidity that most participants never see directly. In calm periods, that intermediation looks effortless. In stressed periods, the terms change. Lenders become selective, borrowers pay up, collateral demands rise, haircuts widen, credit lines get reviewed. None of that makes headlines, but all of it changes the flow of metal and the cost of accessing it. There are also the vault operators and the reporting frameworks that shape perception. Not all inventories are equal. Some are in categories that can be delivered against certain contracts. Some are simply stored metal, not committed to delivery. Many people hear an inventory number and assume it is a pile waiting to satisfy demand. In reality, it is a snapshot of custody, and custody is not the same thing as offer. A bar can be in a vault and still be unavailable because it is not for sale, not for lease, not in the right form, or not in the right place. This is the dislocation. Two sets of data telling opposite stories. The headline inventory numbers can look comforting, while the funding terms for immediate metal look strained. The futures market can imply supply later through the shape of the curve, while lease rates imply tightness now. The price on a screen can swing sharply downward due to liquidation, while physical buyers talk about longer lead times, higher premiums, and reluctance to sell. That is not a contradiction. If you understand that screen price is often a clearing mechanism for leverage, while physical conditions reflect constraints in sourcing, silver's structure makes one concept especially important: the gap between inventory and deliverable inventory. Many viewers hear inventory and imagine identical goods that can be shipped tomorrow. In precious metals, inventories are classified. There is metal that is eligible to be delivered and metal that is registered for delivery. There is metal visible in a vault report that is owned by someone who has no intention of making it available to settle a contract. There is metal that can be converted into deliverable form, but only with time, cost, and cooperation. And there is metal that exists as a number but not as a ready offer. That is why the phrase silver is stuck in the wrong places matters. It suggests the world has metal, but the market ecosystem is dealing with a shortage of immediately mobilizable supply in the specific locations and forms demanded by settlement and fabrication. That kind of bottleneck is exactly the kind that produces extreme volatility because it turns what should be a clean arbitrage into a high-risk operation. Moving metal is not like moving a line on a spreadsheet. It involves shipping, insurance, verification, custody rules, and financing. When those frictions rise, gaps do not close smoothly. They widen. You can see the same logic in geographic splits. Sometimes the most aggressive demand shows up in one region, while the most visible inventories sit in another. Prices and premiums can diverge, not because someone is lying, but because the bridge between those regions is not frictionless. When that bridge is stressed, the market does not immediately equalize, it lurches. The paper price can be pushed down by liquidation at the same time that real-world demand for immediate bars stays firm. That is why analysis has to hold two truths at once. The tape can be driven by forced selling, and the physical market can still be tight. Now anchor the evidence with numbers again, because this is about confirmation. Evidence 1 is the policy shift. December 29th, 2025. Margin on the March 2026. Silver contract rises by about $3,000. $44 per ounce, magnifying volatility and increasing clearing sensitivity. Evidence 3 is the physical funding signal. Multiple lease rate spikes in 2025, including a fifth spike, showing repeated moments when immediate metal was being priced as more valuable than normal. Once you see them together, the narrative changes. The story is not simply silver up or silver down. The story is that the market is periodically hitting constraints that show up as funding stress and policy tightening. Margin hikes do not create scarcity, but they reveal fragility in leverage. Lease spikes do not guarantee a global shortage, but they reveal demand for immediacy and caution from lenders. Large vault totals do not guarantee availability, because ownership and mobilization are what turn inventory into supply. So how does the mechanism work in practice? It is a chain, and it is surprisingly logical. Start with rapid price movement. Rapid movement increases volatility. Higher volatility increases clearing risk. Higher clearing risk invites higher margin requirements. Higher margins force some participants to liquidate because they cannot post additional capital. Liquidation pushes the price lower quickly, which can trigger more risk reductions from systematics. Strategies that respond to volatility and drawdowns. Those strategies may not care about silver's long-term story. They care about risk budgets. This is where silver becomes confusing to anyone watching only price. Forced liquidation can push the paper price down even as physical demand remains strong because the selling is mechanical. Then, in the aftermath, physical tightness can reassert itself through funding costs, lease rates, and premiums, creating an environment where the chart says down while the physical market says harder. That divergence is exactly what dislocation looks like, and it is why silver can whipsaw in a way that feels irrational if you expect one clean narrative. Here is an analogy that makes it concrete. Imagine a city with plenty of water stored in reservoirs. On paper, there is no shortage. But if the pipes feeding one neighborhood are narrow and a sudden heat wave hits, the neighborhood experiences scarcity even while the reservoirs remain full. The pressure drops, not because the city lacks water, but because delivery is constrained. In silver, vault inventories are the reservoirs. The pipes are logistics, financing, and the willingness to lend. A lease spike is a pressure signal. A margin hike is the city raising the cost of using the tap at exactly the moment pressure is falling. This is why silver can feel calm for months, then suddenly behave as if it is an entirely different asset. The metal did not change. The structure changed. Funding conditions changed. Risk limits changed. The system's tolerance for leverage changed. And because silver sits at the intersection of industrial necessity and financial speculation, the adjustment can be violent. Industrial users still need metal. Investors still want exposure. But the cost to carry claims and the cost to borrow metal become the deciding forces. Now, what does this imply if the same signals keep appearing? Historically, when silver enters a phase where leverage is heavy, funding is tight, and inventories are subject to location bottlenecks, the market tends to experience repeated volatility events rather than one smooth adjustment. In a conservative scenario, the system digests stress through time. Margin remains higher, leverage declines, and the market rebalances as participants learn the new cost of carrying exposure. Volatility stays elevated, but it becomes a known condition rather than a shock. In a moderate scenario, dislocations persist for longer. The paper price whipsaws because it is pulled by liquidation and releverage, while the physical market remains sensitive because mobilizable supply is constrained by location and financing terms. In that environment, you can see repeated episodes where the price falls sharply, then rebounds quickly, not because one narrative wins, but because the system oscillates between forced selling and renewed demand for exposure. The result is a market that repeatedly surprises people who assume yesterday's calm rules still apply. In a more aggressive scenario, the market experiences a credibility test. That does not necessarily mean failure. It can mean a sharper separation between immediate and deferred availability and a repricing of how claims are financed. Participants demand clearer terms, more collateral, or more conservative positioning. The important point is that the stress shows up first in the plumbing, margin, lease, and delivery behavior. Price is often the last signal to be understood correctly because price can be dominated by forced flows. The most useful approach is not to forecast a number. The most useful approach is to watch for the next confirmation points. If margins tighten again, that signals volatility is stressing the clearing system. If lease rates spike again, that signals immediate metal is being bid in the financing market. If vault totals rise, but deliverable categories do not, that signals inventory is growing in forms that do not relieve pressure. If institutions keep repeating the wrong places, explanation. That is a polite way of saying the system is working, but with friction, and friction is where volatility comes from. This is the divide. It is not intelligence versus ignorance. It is structure versus story. Story says the price fell, so the shortage narrative is dead. Structure says the price fell because margin forced liquidation, while physical tightness can still exist in parallel. Story says there are 27,818 tons in London, so nothing can be wrong. Structure says those tons are owned, pledged, and categorized, and the question is, how many can be mobilized quickly at tolerable terms? Story says the exchange raised margin to punish speculators. Structure says the exchange raised margin because volatility raised risk, and risk reveals where leverage is too concentrated. And this is the part most people miss. Institutions do not wait for a popular narrative. They respond to constraints, they respond to funding costs, policy shifts, and delivery incentives. Retail attention tends to arrive after volatility has already done its work. That timing difference repeats across cycles, and it is why market education matters. Not to turn anyone into a trader, but to turn confusion into clarity, so that a sudden sell-off does not look like magic, and a sudden rebound does not look like luck. If you take only one thing from this, let it be this. Silver's warning lights are not found in opinions. They are found in mechanics. A margin increase of about $3,000 per contract on December 29th, 2025 is a mechanical fact. Lease rate spikes through 2025 are mechanical signals. London's 27,818 tons and 927,254 bars are mechanical inventory facts. The claim that silver is stuck in the wrong places is an institutional way of describing a mechanical bottleneck. Together, they form a coherent picture of a market where claims, liquidity, and deliverability are periodically colliding. Before we close, notice how the same confirmed signals line up like a checklist. The exchange tightens margin when volatility threatens the clearing system. The lease market tightens when immediate metal is valued more than deferred promises. Vault totals can stay large while the portion that can be moved, lent, or delivered quickly becomes the true bottleneck. That is why professionals talk about availability, not existence. If the market relaxes, you will see it in the plumbing first. Lease rates cool, delivery, incentives normalize, and margin stops ratcheting higher. If the stress persists, the opposite happens. Funding stays elevated, participants reduce leverage, and price swings remain sharp because liquidity is thinner. And if the stress intensifies, the system will demand a clearer separation between paper exposure and immediate metal, simply because that separation already exists in practice. Keep watching the indicators that cannot be faked for long. Watch margin notices. Watch whether lease rates spike again. Watch how discussions shift from totals to deliverable categories. Watch for sudden changes in settlement preferences, like a growing preference for cash settlement over delivery, or unusually heavy interest in taking delivery in specific months. Those are the moments when the market is telling you, quietly, where the constraint really sits. And remember the psychological trap. A fast drop convinces people the story is over, even when the underlying constraint has not changed. That is why silver's biggest moves often arrive in bursts, separated by periods of confusion. The market does not reward certainty, it rewards attention to mechanics. When you hear confident statements on either side, measure them against the simple facts we walked through today. Mechanics do not argue, they just charge a price. That price is the signal institutions follow when rest is noise today. This is Signal in Silver, where we decode what matters before it is headlines. If this connected dots you had not seen, you know what to do. And as the next weeks unfold, the question is not whether silver will stay quiet. The question is whether the market's plumbing will stay calm, or whether the same confirmed signals will keep flashing until everyone is forced to notice them.